With the American economy hemorrhaging an additional $500 million every single day, the 50% surge in oil prices since February 28 is merely the first of 5 compounding waves destined to shatter your financial mental accounting. As Brent crude scales $110 a barrel, and the Strait of Hormuz remains effectively shuttered, the true danger isn't the $5.30 you're paying at the pump, but the psychological paralysis that will cost you far more than the 36% spike in diesel. To survive this rolling series of economic shocks, you must override your survival instincts and recognize the 4 hidden waves of inflation before your budget reaches a terminal breaking point. Every 24 hours, a massive $500 million leak drains from the American economy, a fiscal hemorrhage that shows no sign of slowing down. This isn't a cumulative monthly figure or a quarterly estimation. It is a staggering $500 million vanishing from the national coffers every single day. This crisis can be traced back to February 28, the pivotal moment when the United States and Israel initiated military strikes against Iran. Since that day, the global energy market has been in a state of absolute upheaval, with oil prices skyrocketing more than 50%. The primary choke point for this chaos is the Strait of Hormuz, a narrow 21-mile gateway that typically facilitates the movement of 1/5 of the entire world's crude oil and natural gas supplies. For the first time in recorded history, this vital artery has been completely severed, effectively shutting down and sending shockwaves through every trading floor on the planet. Consider the speed of this collapse. Only 3 weeks ago, Brent crude was trading at a manageable $70 per barrel. Today, that price has blown past the $110 mark. While these massive global figures seem abstract, they manifest at your local station as a rapidly climbing digits on the pump. The national average for gasoline has surged from under $3 per gallon to a current $3.70, while drivers in California are facing the brutal reality of paying over $5.30 for every gallon they pump. Even more critical is the 36% spike in diesel prices, which have climbed to nearly $5.10 per gallon. This is the lifeblood of the 18-wheelers that transport every single item you purchase, meaning the cost of survival is rising in tandem with the fuel in their tanks. The average American household usually allocates about $2,500 annually to fuel, which breaks down to roughly $50 per week. When that weekly bill suddenly creeps up by $10 or $15, your internal alarm system acts like a faulty smoke detector that ignores a slow-burning fire because it hasn't seen a massive flame yet. You likely categorize this extra cost as a minor nuisance rather than a systemic threat. However, this is where your internal software fails you. Psychologists identify this as mental accounting, a process where we sort our finances into distinct, walled-off rooms like gas, groceries, and savings. When the gas room catches fire, we don't logically move resources from other rooms. We panic and start throwing furniture out the window to save the structure. According to the chief economist at the National Retail Federation, this behavioral glitch causes us to immediately axe what we perceive as optional. We aren't just adjusting a spreadsheet, we are reacting to a primitive survival instinct. The first things to be sacrificed are memories and joy. The gym membership is revoked, the long-awaited vacation is deleted from the calendar, and the movie theater seat stays empty. We stop contributing to our future by freezing our investment plans, all because our brain has reclassified these as non-essential luxuries. This is only the beginning of a rolling sequence of economic impacts. You are currently witnessing the first wave, but by the time the general public realizes that a second wave is already making landfall, the majority of these 5 compounding shocks will have already devastated your purchasing power. Fresh meat, crisp produce, and essential dairy products share a common weakness that gas stations do not have. They cannot wait in a warehouse for a market correction. While the fuel in your tank is the first visible casualty, supply chain researchers have identified the grocery aisle as the immediate secondary front for this economic assault. The engine of this inflation is the refrigerated truck, a vehicle entirely dependent on diesel. With diesel prices suffering a 36% spike, the logistical expense of keeping food cold and moving has performed a violent upward leap. You will notice that the faster an item spoils, the more aggressive its price tag becomes. Retailers have spent the last year acting as a thin levee against the flood of tariff costs, but that barrier is crumbling. An economics professor at Boston College notes that businesses simply lack the remaining profit margins to swallow a second massive shock. Once these companies stop absorbing the blow, the consumer will face a rapid and brutal adjustment to sticker prices. Even more unsettling is the third wave, a subterranean disaster involving fertilizer that is currently working its way through the soil. You should be genuinely concerned by this delay because while the crisis is happening in March, the bill won't come due until your autumn harvest. Fossil fuels represent a staggering 80% of the cost to produce fertilizer, and the geopolitical map of its production reads like a list of conflict zones: Iran, Qatar, Saudi Arabia, Bahrain, and the UAE. With the Strait of Hormuz currently locked down, 1/3 of the global fertilizer supply is effectively stranded. The high premiums farmers are paying this month act as an invisible tax on the food you will eat in September and October. Most people will have forgotten the spring headlines by the time the fall prices hit, but the economic damage is being hard-coded into the system right now. Your summer plans are the next target as jet fuel costs have exploded by roughly 85% since the onset of hostilities. Major global players like SAS, Qantas, and the primary carriers in India have already telegraphed significant fare increases. Unlike the volatile daily movements of a gas station sign, airlines utilize long-term pricing models that lock in these high fuel expenses for months. This means that even if oil prices were to collapse tomorrow, your vacation tickets will remain stubbornly expensive. The fourth wave is a slow-motion wrecking ball for the travel industry, ensuring that the cost of your summer getaway is largely decided before you even book the flight. The final and most profound transformation is occurring within the Federal Reserve. The previously held consensus that interest rates would be slashed this year, providing relief for mortgages, credit cards, and auto loans, is officially dead. Current economic projections suggest that the earliest we might see a rate cut is the third quarter, and if inflation continues its acceleration, rates may actually move higher. This shifts the entire foundation of your financial planning. The math for buying a new home or pursuing a refinance has fundamentally altered. As one leading economist warned, the intersection of price shocks and global instability does more than just trim consumer spending. It creates a total psychological lockdown. People are beginning to abandon major life decisions like renovations or vehicle upgrades, not necessarily due to a current lack of cash, but because they have lost all faith in their future purchasing power. 1% might seem like a negligible sliver, but when applied to monthly inflation for March, it represents the most aggressive vertical climb in 4 years, fueled entirely by the initial explosion in energy costs. This surge is merely the opening salvo of an annual inflation trajectory that is already on pace to hit 3% before accounting for the secondary impacts of soaring airfares and grocery bills. The International Energy Agency has discarded all nuance, officially labeling this crisis the greatest global energy security challenge in history. Yet, as you navigate this upheaval, a psychological glitch known as anchoring bias is likely sabotaging your financial judgment. Your brain is wired to hunt for a single, visible metric to simplify chaos, and right now, it is fixated on the numbers at the pump. Whether the sign reads $3.70, $4.20, or $5.30, you are likely treating that single figure as a proxy for the entire war. Because paying an extra few dollars per tank feels like a survivable headache, Your internal alarm system mistakenly classifies a historic global emergency as a routine, temporary annoyance. This cognitive trap is essentially a piece of outdated mental software that we all share. It mirrors the disastrous complacency seen in 2022 following the invasion of Ukraine. Back then, the public focused on the immediate sting of gas prices, while ignoring how that heat would inevitably cook the rest of the economy. By the time that energy shock bled into the costs of rent, services, and basic food items, inflation had already spiraled to 9%, leaving the average consumer with a gutted wallet and no time to pivot. Ask yourself honestly, when news of the Iran conflict first broke, did you calculate the complex domino effect on fertilizer and logistics, or did you only wonder if it was time to trade in the SUV? If you only saw one or two layers of the problem, you are perfectly normal, and that normalcy is the very thing that will lead to a collective economic paralysis. When millions of households fall into this same trap and simultaneously pause their spending, that synchronized freeze creates a drag that can pull the entire national economy into a standstill. The carnage is already being measured across the major indices, revealing a rot that extends far deeper than a few bad days at the pump. The S&P 500 has shed nearly 7% since its peak in January, while the Dow Jones Industrial Average just endured its longest losing streak in 3 years with 4 straight weeks of decline. If your retirement strategy involves target date funds or broad index funds, you are currently watching your future evaporate in real time. The tech sector, which was heralded as the primary growth engine for 2026, has stuttered so badly that the Nasdaq briefly dipped into correction territory with a 10% fall from its highs. Even more alarming is the Russell 2000, which reflects the health of smaller companies sensitive to borrowing costs. It officially crossed the 10% correction threshold last Friday. Even the traditional safe havens are proving to be treacherous. While Brent crude reached a peak of nearly $120 a barrel before pulling back to settle at $112 on Friday, its highest close since 2022, the gold market witnessed a historic betrayal. Gold prices initially screamed past $5,400 per ounce only to suffer a catastrophic single-week crash of more than 10%, marking its most pathetic performance since 1983. Wall Street's primary fear gauge, the VIX, has performed a violent leap from the mid-teens to nearly 32, signaling a total collapse in the expected behavior of traditionally safe assets. When these market tremors hit, your amygdala, the brain's primitive smoke detector, effectively hijacks your rational mind, screaming for you to liquidate everything to save what remains. This biological knee-jerk reaction is known as loss aversion. Data from Princeton reveals a startling imbalance in our internal value system. The psychological agony of losing capital is roughly twice as potent as the joy of an equivalent gain. Consequently, a $5,000 decline in your portfolio does not register as a $5,000 setback. Your central nervous system treats it as a $10,000 existential emergency. We are essentially running Stone Age survival software that views any loss as potentially fatal, even though that wiring is catastrophically unsuited for managing a 401k in a modern digital economy. This disconnect creates the behavior gap, the chasm between the market's actual performance and the diminished returns the average investor actually keeps because they buy during periods of euphoria and flee during moments of terror. But what are the actual consequences when people succumb to these impulses during a global conflict? An exhaustive analysis by RBC Wealth Management covering 20 significant military interventions since World War II shows that the S&P 500 dropped by an average of only 6% during those hostilities. Furthermore, a broader study of 40 geopolitical incidents over 85 years found that the typical first-month decline was a mere 0.9%, which was historically followed by a 3.4% rally over the subsequent 6 months. The consistency of this pattern is undeniable. Those who acted on their fear merely turned paper losses into permanent ones, while those who remained steadfast through the storm were the ones who participated in the inevitable rebound. Consider the market collapse of March 2020. It took a mere 57 days for the indices to claw back to their starting point before resuming a climb to new heights. The tragic irony is that the panicked sellers who liquidated at the bottom often remained paralyzed on the sidelines, fruitlessly waiting for a signal of certainty that never arrived while the recovery passed them by. To be blunt, the math of market timing is a trap that punishes the fearful with surgical precision. Because the market's most explosive days of growth and its most devastating days of decline usually occur in tight clusters, missing just 10 of the top trading days over a 20-year span will slash your total returns by approximately 50%. If you miss 20 of those days, your portfolio will struggle to even outpace inflation. You simply cannot harvest the sunlight of the upside if you have already retreated into the cellar during the clouds. This brings us to the nightmare that keeps elite economists awake: stagflation. This is a rare and poisonous environment where surging inflation and stagnating growth collide. It functions like a financial Gordian knot. The high interest rates needed to kill inflation also strangle economic growth, while the low rates used to jumpstart an economy only serve to blow more air into the inflationary fire. There is no easy path out of this labyrinth, and the Federal Reserve is currently immobilized. History is currently repeating itself with a violent lack of subtlety. Every significant surge in oil prices over the last half-century has functioned as a herald for economic recession, and the current environment is no exception. We are witnessing the most substantial supply interference in the history of the global oil market, with a staggering collective drop of at least 10 million barrels per day coming out of Saudi Arabia, Kuwait, Iraq, and the UAE. If the blockage of the Strait of Hormuz continues, market analysts are bracing for Brent crude to scream toward $130 per barrel. At those levels, the situation transcends mere annoyance at the gas station. It inflicts structural damage on the very foundation of corporate earnings, household stability, and consumer activity. The historical mirrors are terrifying. The 1973 OPEC oil embargo paralyzed the economy for a 2-year contraction. The 1979 Iranian Revolution doubled prices to spark another downturn, and the 2008 spike served as the final push before the great financial crisis. The recovery from these shocks is notoriously asymmetric, governed by what economists call the elevators and parachutes effect. Prices ascend with the speed of an elevator when costs climb, but they float back down with the agonizing slowness of a parachute when they finally break. We saw this immediate verticality following the 2022 invasion of Ukraine, just as we saw the glacial descent of prices after the 2005 Gulf Coast hurricanes crippled refining capacity. Even if the Strait reopens today, you must prepare for a prolonged period of pain. Production facilities require weeks to ramp back up, and it will take months for prices to drift toward normalcy while high costs continue to ripple through the tail of the supply chain. The United States has released 172 million barrels from the Strategic Petroleum Reserve, the largest such move in history. But this is a temporary tourniquet, not a permanent cure for the rupture. It is time to take a deep breath and pivot toward what you can actually influence. The defining line between those who survive an economic storm and those who are washed away is rarely the storm itself, but the decisions made while the wind is at its peak. Your most critical directive is to resist the urge to panic sell. Every major financial study confirms that liquidating your portfolio in a moment of geopolitical terror is the most expensive blunder an investor can commit. A certified financial planner would remind you that while wars can persist for several years, your investment horizon spans decades. Retreating entirely to cash does not erase your danger. It simply trades the volatility of the market for the silent, certain destruction of inflation and the massive loss of opportunity. There is no such thing as a risk-free path in this landscape, and being overly cautious carries the ultimate risk of outliving your capital. You must remain invested to capture the eventual rebound, while simultaneously shoring up your immediate defenses. With top-tier high-yield savings accounts currently yielding over 4%, the financial market is providing a rare incentive to fortify your defenses. If your liquid reserves are currently insufficient, you should view this as a mandatory window for capital accumulation. It is helpful to visualize your emergency fund not merely as a stagnant pool of savings, but as a psychological firewall designed to block your own panic-driven impulses. The true value of this cash runway is found in the calm it provides. It is the fundamental difference between observing a global crisis with calculated concern and viewing it through a lens of total desperation. When you lack a safety net, your brain defaults to high-stakes errors that carry a heavy price tag. By securing a 4% return, you are essentially purchasing an insurance policy that guarantees you won't be forced to make a life-altering financial mistake when the news cycle turns dark. Procrastination in this environment is a luxury you cannot afford, as the first wave of gas price hikes has already breached the shore. Still looming on the horizon are the subsequent surges in grocery bills, airfare, and a fundamental repricing of interest rates. If you wait until all 5 of these economic waves have fully crashed before recalibrating your lifestyle, you will find yourself in a frantic, reactive scramble rather than a controlled, proactive adjustment. The smarter move is to aggressively prune all discretionary expenditures immediately. By redirecting those funds into your financial cushion now, you prepare for the inevitable arrival of more expensive produce and flights. Why would you wait for the budget to break when you can reinforce the structure before the heaviest pressure arrives? Maintaining your investment contributions during a downturn feels like a betrayal of your survival instincts, yet decades of empirical evidence support this exact behavior. When you commit to a rigid, recurring investment schedule, you are utilizing dollar cost averaging to your advantage. This mechanism forces you to automatically acquire a higher volume of shares when the market is depressed and fewer when prices are peak, effectively lowering your average cost per share over the long haul. The same market volatility that creates terror today is actually manufacturing the discounts that will likely define the best investments of your lifetime. History shows that those who flinched and paused their contributions during past conflicts ended up chasing the recovery and buying back in at significantly higher valuations. Finally, you must conduct a surgical analysis of your personal energy footprint. The financial equation for long-distance commuting has shifted toward fuel-efficient vehicles, just as the burden of high-interest credit card debt has become a critical vulnerability. Since the Federal Reserve is unlikely to provide relief through rate cuts anytime soon, the cost of carrying revolving debt is significantly higher than was projected just 6 months ago. For the small business owner, the diesel surcharge has already turned shipping logistics into a margin killer. Survival now depends on renegotiating contracts, consolidating freight, or sourcing supplies from more local vendors. Whether looking at the 1973 oil crisis or the 2020 pandemic, the ultimate differentiator between financial resilience and failure has never been raw intelligence or initial wealth. It is purely a matter of your response time. Financial security in a crisis is rarely a matter of how much you earn, but rather how quickly you pivot. Historical evidence shows that households with the highest incomes are not necessarily the ones that emerge from economic shocks unscathed. Instead, the victors are those who identify early warning signs and execute unglamorous tactical shifts before the full weight of the crisis descends. This involves a disciplined focus on the fundamentals, slashing discretionary spending, aggressively reinforcing savings, staying committed to investment contributions, and dismantling high-interest debt. These invisible adjustments, such as redirecting $200 a month from a restaurant budget into a high-yield savings account, function like a quiet fortress being built brick by brick. While no one broadcasts these small moves on social media, they create a massive structural gap between the prepared and the oblivious. Because economic disruptions typically require 6 to 12 months to fully cycle through the global system, these preemptive strikes accumulate significant compound power simply because they were initiated before the pressure became unbearable. Most people will remain in a state of cognitive inertia until the fourth or fifth wave of this disruption has already decimated their bank accounts. By that time, the opportunity for proactive defense has vanished. Your window for action is open right now, and the anxiety you feel should be interpreted as a vital data point, a biological signal that you are paying attention to a legitimate threat. The danger is not the fear itself, but allowing that fear to dictate your strategy. Your nervous system is hardwired to favor panic selling, freezing in place, or engaging in the delusion that the storm will simply pass. But these primitive impulses are catastrophically wrong for modern financial markets. The superior response is silent and systematic. You must review your current budget, audit the health of your emergency fund, maintain your automated investment schedule, and precisely map your vulnerability to energy prices. Once these protocols are active, you have earned the right to ignore the headlines. Financial news is optimized to monetize your dread, not to facilitate your progress. After you have taken concrete action, the fear serves no further purpose. You have managed uncertainty before, and you possess the tools to navigate this cycle. The only remaining variable is whether you will seize control of your decisions or surrender them to the chaos. Join the conversation below by identifying the specific move you are making today to secure your future. Subscription is open for those ready to stay ahead as this global story continues to unfold.